Hi, welcome to this live webinar. Not got the best lighting set up today, but we wanted to go live despite the difficulties that we've got and tell you what the story is. Today we're discussing dual residency and dual residency as opposed to non-resident or tax resident for expats. So we want to look at this specific issue for expats living and working abroad. So you're either everyone has to have a tax resident somewhere. You have to be a tax resident in the UK or tax resident in another country. If there's a double taxation treaty between those countries, then that allows for relief from some UK taxes or from overseas taxes and any taxes at source. So those are the issues that we're looking at today, and trying to identify what are the issues for an expat living and working abroad. Domicile is part of it. If your domicile is the UK, then you've got a lifetime liability to certain types of inheritance tax and capital gains tax. The next level down from domicile is nationality. So if you're British national and you're spending any time in the UK, then you're always going to be liable for dual taxation on a dual residency basis. If you're a British expat and you spend any time in the UK, you want to avoid UK tax, there has to be a double taxation treaty between the country that you stay in and the country that and the UK country. So any time in the UK as a UK national during a year leaves you liable to tax unless there's a double taxation between the two countries. If there isn't a double taxation treaty, and if you're getting taxed at source in your other country of residence, tax residence without a double taxation treaty, then the situation that we've got is that you can potentially claim a tax credit against the UK tax. So you'd be taxed as a UK citizen at the UK's highest tax rates, where there's no double taxation treaty, with potentially the best relief to claim a tax credit against the UK tax liability, not the overseas liability. So these are issues to consider. Not all double taxation treaties are the same. There are significant differences in the way they treat income, earnings, gains, profits, royalties, dividends, property rental income, and inheritance taxes. So all those things, all those different treatments that you might enjoy in a different jurisdiction can come home to bite if you get caught under a dual residency tax assessment. So let's have a look at some of the differences on that. If you're, we start again. Definition for a tax residence is very, very clear. If you live in a country for 183 days, then you become a tax resident in that country. As a UK national, if you spend any time in the UK, then you're potentially subject to a dual taxation assessment. Now, if there's a double taxation treaty between the two countries, that gives you an ability, and within that double taxation treaty, there are tie-breaking rules to assess whether you are taxable for that income or that gain or that profit in your in one country or the other, and those are all covered under the double taxation treaty. If there's no clear distinction between the two, then there's a set of rules that come in to provide a resolution of that, and those can be applied starting in the tax return you're completing as an expat and non-residents. And those rules are quite definitive and progressive, and allow a resolution to minimise any double taxation, and for a UK expat to make sure that they're paying the lowest amount of tax possible, and saving, in consideration of the time that they're spending in the UK. So how are sort of the dual residency rules defined? How are they resolved? So the OECD is the international organisation that creates these tax rules and creates the draft double taxation treaties. But each one is slightly different, but it includes ways to establish and settle differences between the two. Now, they may be contained within the double taxation and agreement and quite clear, but then when you go beyond to the next level, and you're trying to get a decision, whether you're making this decision in a court, a tax tribunal or appeals, or whether you're making it on a tax return, these are the factors that the taxman is looking at. First of all, he's looking at where is your permanent home. So where are you continually living in? So in fact, now post Brexit, it's tightened up for EU expats within the EU. It's that, and it's true for most countries. You've got to have a permanent residence for your business or for your family in that country of residence for you to become a tax resident there. And having a permanent home is the first criteria of becoming a tax resident in that jurisdiction. So that is the first test. So where is your permanent home? But some expats will have a home in 2 or 3 or more countries. And so if the permanent home rule doesn't work, there isn't a definitive place, it then comes about where the centre of the family and business interests are. So where's the family living? Where's the business based? Where's the economic activity arising from? And that can give the authorities, or that can demonstrate in the tax return that we do for clients, that the earnings are from abroad in the expat country of tax residence, and that the UK trip is a short holiday or short business trip, and the economic activity is not the UK, and therefore the tax should be payable and accessible in the expat country. So that centre of interest is a key point to argue to defend an expat's non-resident status in the UK. If it fails, then the next line that the UK will use is habitual habits. Okay, now if you want to live, as some people used to do it, in the north of France and Jersey, and travel into the UK for the working week for some of the year and avoid tax like that, it doesn't work anymore. If you're frequently traveling to the UK habitually, then you can still be considered to be dual residents. So if you've got a business interest in the UK and you're traveling regularly every month, every week, or twice a month, or whatever, then that habit and routine to manage your economic affairs in the UK can deem you to be resident in the UK. And when you are dual resident, potentially you can pay tax at the highest rate in that jurisdiction. And then the final criteria would be nationality. So if it's not clear whether you're tax resident or not, by default, the UK have always got this extra hold on UK expats, that their nationality would define that they're liable for those UK taxes. For a non-UK expat living and working in the UK, they wouldn't have that constraint with the UK, but they'd have that constraint with their home country, be that Denmark, Cyprus, Portugal, or USA. Wish I hadn't said USA, because they do treat people differently, but that's not for this webinar. So those are the 4 steps that the double taxation treaty under international rules it was determines whether somebody is tax resident in one country or another, whether the expat is in which country they're liable for the tax in, where the permanent home is, where the centre of interests are, where they habitually live and work, and what their nationality are. So let's have a look at some more examples of how dual nationality has a big impact. The USA have got special rules for their citizens, and we're not discussing that here. But under the new OECD Double Taxation Treaties, the standard draft, over the last 5 years, countries have been able to establish new agreements. And for example, Cyprus and the UK now have a new Double Taxation Treaty that was re-signed in 2018 and came into effect in 2019. There's a number of significant differences on this, but the main thing is that a government service pension arising from any country, primarily of your nationality, obviously usually, but it is taxed in the country from which it's paid. So if you're a retired UK expat and you go to live and work abroad, in a country with a double taxation treaty, a latest format, then potentially your government pension is going to be taxed at source back in the UK. Now, I'm going to use the example of Cyprus for this exercise, but we can help our clients in lots of different ways. We offer free reviews for all new inquiries at projectpartnership.com. So with Cyprus, if you've got a government service pension from 2019 under the Double Taxation Treaty, is taxed back in the UK. Now there's a transition period which ends at 2024, but let's ignore that for now. But anybody who's still being taxed in the old way, that will end by 2024-25. Under the Double Taxation Treaty, if you've got a government service pension, it will be taxed in the UK. Now, if your government service pension in the UK, and we're talking about military, civil service, NHS, local authority, anything that's paid for by the government, if it's $12,500 a year, that's your personal allowance. So as an expat, you're not going to pay any UK tax. But if your pension is $125,000 a year, then obviously you're going to be paying 40% tax in the UK, and potentially start eating into your personal allowance for that pension income. And there's no avoiding that. If you've got a government service pension as an expat, it is going to be taxed in the UK if you're living and working abroad in a country with a modern day double taxation agreement under the latest OECD rules. It's vice versa for Cyprus as well, and that's all. The good news for UK expats is that government service pension does not need to be declared on the reciprocal double taxation treaty. So a UK expat who becomes fully tax resident under the double taxation treaty in a second jurisdiction and gets a government service pension, they don't declare it on their tax return in their tax resident country. So that government service pension doesn't need to be declared in Cyprus, and therefore it's not taxed in Cyprus. And you still get the Cyprus personal allowance of around about £17,000. So the advantage of this system is if you've got mixed income sources, you've got the £12,500 UK personal allowance and a £17,000 Cyprus personal allowance before you get taxed. It depends upon the mix of your income. If all your income is government service pensions, you're going to be all taxed in the UK, no matter where you're living and working abroad. But it does give some options. Having said that, there's different types of income as well, and other types of income in the UK can be taxed. They could be fixed to the UK and taxed there. So if a capital gain or property rental income or property capital gain arises, they're fixed incomes which we taxed in the UK or in Cyprus. So those things need to be considered as well. So there's always this element of dual residency, dual taxation brought about by nationality and where the assets are. Okay? Another consideration with Cyprus is on foreign income. So if you're living and working abroad and you're working from a Cyprus tax base, so you could be working in Saudi Arabia, Dubai, UAE, you could be working in Africa or Asia, but your home and your tax resident is in Cyprus, then some additional interesting options open up. You can have your if you're based in the Middle East, for example, very attractive tax regimes. But if you wanted a residency in Cyprus, you could do that. If you're living and working abroad from Cyprus for more than 90 days a year, but you are a Cyprus tax resident, you don't pay any tax on that foreign income. So if you're earning money out of Africa or out of Asia, that's not declarable when you're a Cyprus tax resident. And the only things that Cyprus will tax you on is income and gains and profits arising in Cyprus. So it's something to consider if you need a flexible tax residence for your worldwide consulting or contracting business. Cyprus can be very tax efficient to allow you to go in, do short jobs in one country, be a Cyprus tax resident, but not pay tax in Cyprus or in the country where you're doing the job. So, under dual residency, what type of reliefs can you get? Well, it's quite obvious. You can get full relief, you can get no relief, and you can get a bit in between. And so we talked about the fact that if you're tax resident in another country with a double taxation treaty and it allows tax to be applied elsewhere, then you can be taxed in the other country. However, if you've got some fixed income in the UK or your other tax country, that will always be taxed there. If you're spending any time in the UK, you're potentially opening yourself up to dual taxation residency. If there's no double taxation treaty, you will be applied those taxes in any case. Income like dividends and bank interest, they're movable, so that they are taxed where you receive them, not where they're paid. But if you've got crypto gains or investment gains, they're taxed where the gains arise. So if your investment portfolio is in the UK, that's where the tax will be paid. If you've got a pension based in the UK, that will be taxed from the UK, and unless you have some arrangement under a double taxation treaty. If you're are not meeting the non-residence rules, then you're opening yourself up to potential taxable liabilities, and therefore you need to meet the joint constraints. And so we can do that in a number of different ways. So, but that means considering your tax residence and your non-residence and the conditions about your nationality, your centres of interest of your family and your business and your economics, and where your permanent home is, as well as where habitually you're living and working from. That gives expats two options. It gives them the option to make more money abroad and pay less tax back in the UK. But if you want the flexibility of being in the UK and earning salaries from abroad or being a nomad, you need a tax residence somewhere. and it may mean that you're going to pay some tax on some or all of the income in the UK. For more information and guidance on that, contact us at productpartnership.com. We offer a free review to all new inquiries that we receive from people, and you can subscribe as a retained client and get advice online and consultations online with me and the team. If you need more help, we can offer full services around tax planning and tax saving and residency for expats living and working abroad. Thanks very much for listening. Don't forget to subscribe down below to the channel and share it with your friends, and we'll see you again next time. Thank you. Always gets me that I have to double click to stop the show. Thanks for listening anyway.